Hey everyone, Steve here from the Seller CPA, your e-commerce CPA. Today's topic is estimated income taxes and whether you should be making quarterly estimated payments to the IRS to cover your income tax liability. So this topic is something that there's a lot of confusion around, and it's something that new business owners need to learn, especially when they're just getting started out, because in their first year where they're just starting in business, if they're at a loss, they might not be needing to pay any taxes, or if they previously were employed, they usually got a refund because they overwithheld from their W-2 job. When you're self-employed as a single member LLC, a sole proprietorship, an S-Corp owner, or a member of a multi-member LLC, and if you're expected to owe $1,000 or more in federal income tax, you're supposed to make quarterly estimated payments. And those quarterly estimated payments are made during the year that you're generating the income, and that goes towards the liability that will be calculated on the tax return that's actually prepared and filed in the following year. Sometimes I get asked by business owners, well, why would I want to pay my taxes in advance? Well, it's actually not optional. It's something that's required by the IRS. And if you don't make your quarterly estimated payments, you're actually going to owe penalties on top of your tax. So let me explain how quarterly payments work. If you file a tax return and you have an amount due that's more than $1,000, and you expect that your income is going to be just the same, if not more, in the following year, then you need to start paying your quarterly estimated taxes. And ideally, you should do this in any year that you expect to owe $1,000 or more before you file if you're running a business and you're expecting to owe that much. Now, the first payment will be due on April 15th, which is the same due date for any tax due when you file your 1040. And then the second payment is due June 15th. The third payment is due September 15th. And the fourth payment is due January 15th of the following year. Now, if any of those dates fall on a weekend, the payment will be made on the following business day. So you may be wondering, why is this required? Well, it's required because when you're employed and you get a paycheck every 2 weeks or every week or every month, when you get that paycheck, you'll see that there's withholdings. So taxes are being withheld from your paycheck and being remitted to the IRS on a regular basis. When you're self-employed, you're generating income, but you're not necessarily getting a paycheck where you have withholdings. So you voluntarily need to remit an amount of income tax that's representative of the amount of income that you earned up until the prior months of that generated income, and that's what the estimated payment is for. Then when it comes filing time and you actually file your tax return on April 15th or before, any amounts that were made in estimated payments in the prior year or on January 15th of the year that you're filing will be applied towards any balance due. If you end up overpaying your estimated taxes, you'll get a refund. If you end up underpaying your estimated taxes, but they were at least the minimum that was required based on your tax in the previous year, then you still might owe more money, but you won't be subject to a penalty. And if you make no estimated payments, you'll definitely owe money and you'll be subject to penalties. So now that you know what estimated taxes are, you might be wondering, well, how do I actually pay these taxes? Normally, when your CPA prepares your tax return, they're going to generate a schedule of estimated tax payments for the following year based on the safe harbor, which is the minimum that's required based on your previous year's tax. And usually you'll have the option to have those withdrawn automatically from your checking account, or you could make them manually by writing a check or going to irs.gov and making an estimated payment. So if you tend to not set aside money for taxes, having the payments automatically taken out will give you a good target to focus on and make sure you're reserving that money and having it taken out before you do something else with it, because you're going to owe it, and it's better to pay it in advance than have a huge tax bill at the end of the year with a penalty that you might not have reserved money to pay for. The other thing is around the certainty in the level of income. So if you're not sure that your income is going to be the same, it's best to kind of make the payments manually and keep track of your profit and loss, and then look at what the estimated payments should be based on the previous months of profit and where you expect to be for the end of the year. Now, this is something that a CPA can help you with, and this is not necessarily just tax prep, but this is where tax planning comes into play. So you shouldn't just necessarily see your CPA once a year and have them prepare a tax return. But if you're expecting to owe money and you want to really dial in your estimated tax payments, you should meet with them quarterly to review your estimated tax payments to make sure they're done right. So hopefully you found that video helpful. If you did, don't forget to like and subscribe, because I'll be producing new videos every week just like this. And if you need help with your income taxes, go to sellercpa.com and click book a call to work directly with us.